Hello, everyone. I'm Joanne Landa, Senior Investment Strategist with Wells Fargo Private Bank. Thank you so much for joining me today, and I am so excited to be able to share some thoughts on what we're seeing in the economy, the markets, and really creating and preserving wealth for 2021. I think it's fair to say that 2020 has been a time for stress testing. We've experienced pandemics, fires, floods, civil unrest, polarized politics, market bulls and bears, and economic recessions and recovery. And quite frankly, the year isn't over yet. So it's not without surprise that we are all looking at 2021, what it holds for us, with maybe a bit of caution, as well as maybe a little bit of exhaustion as well. So, but just take pause and look at what we've all just come through this year. And when we look at what is in store for us for 2021 in the new year, take comfort in what you have just weathered, and a very difficult situation, a very difficult year, and that experience is priceless. So what I'd like to transition and talk about, a couple of things in our time together, is I want to talk about the economy and the markets and some of the opportunities that we're seeing going forward, but also about how to evaluate what your personal situations are, your business situations, your risk tolerance, and really how do you combine those to take advantage of what's going on in the economy and the market. So we'll go over to our first slide here, and we can take a look at some context of what's going on in the economy. So although the pressures I just mentioned may continue to have some longer term implications, we are seeing some opportunities going into the next year. So just to give you a sense, we're seeing for 2020, we see global GDP growth coming in at a negative 3.1%, and US GDP growth coming in at a negative 3.7%. So let's contrast that into what we're seeing for 2021. So we're looking at increased expansion into next year, and the pace for global growth, we're looking or anticipating at about a 5.2%, and US GDP growth at a 3.8%. So our outlook going into next year really is, we believe that there are investment opportunities to take advantage of that. Going into 2021, there will continue to be a push and pull with economic data. So our next slide covers some of that information. So we do anticipate moderate growth in 2021, but it will be uneven. So there will be some bumps along the ways, and there will be a separation between different sectors and different economies that some will be very strong and some will actually lag a little bit. So as the US overcomes its pandemic threat, the US will remain on the leading edge of recovery along with China. Europe's economy should gain momentum after the winter surge of the COVID infections decrease a little bit. And among the emerging economies, China should lead the way, while some other emerging economies will have some strong rebounds, but we think Latin American economies will lag. Even with the US on the leading edge of the economy, we expect further US dollar declines, mainly against the euro, as the Federal Reserve, this is really an impact of what the Federal Reserve is doing here in the US by adding more money and stimulus, both in terms of keeping interest rates very low, but also in terms of their continual securities buyback process. So in all, we do see gradually a broadening global economic recovery and a weakening dollar, and those two combinations should support global asset markets over the course of the year. So in terms of equity, the drop we experienced in the spring with the beginning of the pandemic brought the longest bull market that we've had in the US to a close. So moving forward, broadening economic conditions should mean we see an earnings rebound that could support equities prices going even higher. We favor US over international equities and but we still continue to recommend going higher quality, which is a shift to be made in 2020. And we continue to see that as a place of opportunity in 2021. So looking at higher quality investments. Additionally, we do see some opportunities in more traditional cyclical sectors, and especially those, as I mentioned, with higher quality characteristics. As some uncertainties ease in 2021, we do expect moderately higher interest rates, but the economy's slow pace should prevent interest rates to return to historical levels. So we're still going to be low in that aspect. These historically lower rates should add to high demand for yield. And in searching for that yield, we prefer credit opportunities and would use active managers in those areas, meaning if you're looking at high yield or preferred stock where you're taking a little bit more risk to get that yield, using active managers rather than looking at individual securities there. We also favor tax advantage municipal bonds, including high yield municipal bonds, especially for those that are in the higher tax brackets. For real assets, so think of real estate as well as commodities, anything tangible we identify as a real asset. It's a mixed bag here. So we believe that commodities may see a bounce as they experience a rebound in demand. So think of oil prices, how they've been fairly low for quite some time. And with the global recession, there's been a little bit lower demand. But as we move forward into 2020 and demand increases, we could see some prices stabilize and move up slightly. But with real estate, it's a little bit of a different story. Real estate investment trusts, or REITs, should continue to face headwinds in the coming year as really they're coping with these post-pandemic realities as far as what occupancy levels will be, what geographic impacts will have across the country. And finally, for alternative investments, we believe that investors should gravitate towards hedge funds and private capital portfolios that are more focused on themes coming out of the COVID pandemic crisis. So often sectors facing the biggest challenges through these crises can support the best long-term investment opportunities. And so hedge funds and private capital are in a place to be able to benefit from that. So that was an overview of the US and global economy, some of the investment markets, but what does this really mean to any of you as personal investors as well as business owners and managers? So one of the things that is really important is how do you take advantage of this data and the information that the market is sharing with us? But before we dive into, is it XYZ company or is it that bond? What's most important is that you really look at why you own something versus what you own. So a large part of successful investing is really first to identify what your goals and objectives are as an individual, as well as a business owner, or for the business in general. Because if you don't have that structure around what you own, doesn't necessarily, you can't identify what it's going to do for you in order to achieving those goals. So behavioral finance is a study that's been around for the last few decades. It's catching a lot of wind over the last 10 years, and it really helps address the emotional aspect of how people invest. And during a pandemic, I can't think of a better time to really revisit this and look at what some of the benefits of behavioral finance is. So by establishing your goals and objectives first, when you evaluate a new investment or rebalancing an existing one, the structure of your goals and objectives give you a framework to identify how much or little risk you're willing to take, or when you're reaching for those higher returns, or where to put your next new dollar. If you're already heavily invested in stocks and say collectibles, but you don't have any cash available or any retirement savings, when the economy enters into a recession, you may have a difficulty emotionally staying your investment course because you don't have access to that liquidity that you may need when things get difficult. On the other hand, if you're too conservative or you have a large emergency fund, you may never be able to have may never be in a position to have your assets grow for you, and you may never create more wealth for you or your business or your family. So that's important to look at the balance between all of those. Once your longer term goals are in place, it can be helpful to make longer term strategic changes across your asset mixes, as well as shorter term, and we were define shorter term tactical shifts as say 12 to 18 month opportunities. So you want to look at both sides of those. And so some of the highlights of where we currently are seeing market opportunities are, and so once your longer term goals are in place, it can be helpful to make both longer term strategic changes in your asset mix, as well as shorter term or tactical changes. And we see the tactical is more of a 12 to 18 month opportunity, and strategic is beyond that in terms of a timeline. So we encourage investors to do both of those in rebalancing and evaluating what their wealth strategies are and investment strategies are going forward. So currently, what we're seeing some opportunities here in the marketplace and the economy are highlighted here in our next slide. And so just to give you an overview, a lot of people, when things get difficult, they want to hold a lot of cash. But if you're paying attention to where interest rates are on your bank deposits or short-term treasuries, really you're not earning any interest rates. So you want to be careful that you don't have too much cash on the sideline, but enough to take advantage of opportunities in the future. We're also, as I mentioned, still positive on equities, but really focusing on US large and mid-cap opportunities, and underweighting other areas such as some of the international markets. So what you're seeing here in these reference is just some tactical shifts that we are anticipating where we see opportunities for 2021. And it's an example of how both the market, the economic data, and your personal or business situation should come together to allow you to make those changes within the portfolio. So just to summarize, when we think about portfolios, we really do believe that it's better to be proactive than to be reactive. And so right now, as I mentioned, hold some cash, but not too much, so that you are available to take advantage of the opportunities in the coming year, and just selectively increase risk as the economy improves. And then the last thing in terms of some of the opportunities is looking at diversifying your streams of income. So what does that mean in terms of portfolios? So looking at interest coming from taxable bonds as well as tax-free municipals, cash flow coming from high yield bonds, cash flow coming from dividends. So if all of your income streams are coming from one place, for example, your US Treasuries, maybe you want to diversify and see what other assets can provide you with cash flow as well as we go into 2021. So one of the last thing I just wanted to leave you with for more ideas on how to be proactive as we move into 2021, please feel free to download our Wells Fargo Investment Institute special report for 2021. It's named Forging a Path Forward, and that is available mid-December. So I'd like to thank you all again for including me in this wonderful event. It's been both a pleasure and an honor, and best wishes for a healthy and a prosperous 2021. Thank you.